Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. The peak in mid-May was not the key to the recent move lower. No. Instead, it was the combined big key reversal down and bearish engulfing pattern that finally put to the moves higher in this market. And that happened the week after. I suppose the most surprising thing, actually, I suppose it isn't that surprising, but what's on the face of it is a lesser Fibonacci level, a 61.8% Fibonacci level at 389.5 to prove to be the low of that week. However, last week that support gave way, but only down to what appears to be a stronger combination of supports. They are the rising short medium moving average, currently at 378.5, and the 50% Fibonacci on the March to May move at 374.75. This is just the tip of the support, as further below we have the 50% Fibonacci line for the whole of the 22 action at 348, and then the rising medium moving average, currently 344.75, plus the lows of March between 311.75 and 315.75. I said last time, and I quote, "Even down here we are still in pullback territory, in theory at least. It's only when we start going below the rising long moving average, that's currently 308.75, that we must start to consider the bullish incentive expired and another force may be taking its place. Personally, if we see prices back within the wider congestion created by the January action of 258.5 to 288.5, well then maybe I would really start to look on the downside again. Otherwise I would keep a wary eye lower." End of quote. Now, I cannot tell just yet if the hesitation we've seen over last week and this is a hesitation to go up, down, or stay sideways. But that will become evident soon enough, as from below the medium moving average is now entering the frame. And this may well be the incentive the market needs to move to the next scenario. So overall, we are still in pullback territory, but there may be another action soon that will clarify this or put it under further pressure. London UK feed wheat. A lot less to go on here compared to some of the other grain markets, but we can still see some interesting actions and the one key pattern that was triggered and subsequently made to come to fruition in recent times. The peak in late March was the start of the last major pattern we had here. I have repeatedly pointed this out since I first noticed it back then. We had a late March to late April ascending wedge pattern. This pattern was not the best ascending pattern, wedge pattern, that I've ever seen. Even now it still looks a bit, ropey. But it is a true pattern, and it reached not only its primary target, but also the hardest to achieve secondary target. What became very interesting was what the market did immediately after reaching that secondary target. So, let me describe the situation. With all the bullish energy spent, the market suddenly turned a shade bearish, coming ever so close to make it into a weekly key reversal down. The conditions were set by the close of business 3 weeks ago, and all it needed to make it happen was a close 3 Fridays ago at or under 335 even. That was all it needed. Well, we closed at 336.5, a shade away from fully bearish, but enough to prove two things. Firstly, that there is some serious technical analysis action going on in this market, and secondly, to give this market a shadow of potentially lower prices in the following week. Now, true to form, as prices dropped every day thereafter until the end of last week, the market pierced and closed below the first line of significant support, the rising short medium moving average, currently 319.80, and dropped all the way down to be halted by the lesser Fibonacci levels, 287.55, 285.70, as well as the 50% Fibonacci line for 2020 at 283.70. The questions here are the same as in the other grains. Firstly, is this a pullback or the beginning of a bearish phase? And secondly, how far will the market drop? Well, the answer to the first question is yes, it is still a pullback, but I would keep a wary eye on it. The answer to the second question is it depends. Sorry for being obtuse, but it does depend. Right now, all we have seen is a pullback that's punched down through the first significant line of support and halted at the next. There are other supports, such as the congestion between 262.5 and 265.5, then 250.5, and then a band between 239.25 to 245.15, which contains inside it the rising long moving average, or just peaking outside of it actually at the moment, and that's 247.55. Now this last one, the long moving average, is ultra important, and one could only say that the bullish incentive has been extinguished and the bearish incentive has replaced it if that one, the long moving average, is broken. There is one other significant dynamic support that needs consideration to all these. I think you know what it is. And that is the medium moving average, currently 285.05. If prices should fall to whatever the level the medium moving average rises to, so if they come down to where the medium moving average is, then it would be worth reassessing the whole situation. Please note, the medium moving average is now pushing up through the Fibonacci levels between 283.70 and 287.55. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.